You are listening to Keystone's Stock Talk Podcast, episode 49. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at Mogo Finance Technology Inc., symbol MOGO on the TSX, an independent consumer fintech small cap that boasts a suite of mobile financial products providing solutions to help manage and improve your financial health. After a solid Q2, a listener asks us if the turnaround is in fact on and whether it is a buy, sell, or hold at present. Our star of the week is Canopy Growth Corporation, symbol WEED, WEED on the TSX, a diversified cannabis and hemp company offering distinct brands and curated cannabis varieties in dried, oil, and softgel capsule forms. The stock jumped 30% Wednesday morning alone, following the announcement that New York Stock Exchange listed beverage giant Constellation Brands returned to invest another $4 billion in the burgeoning marijuana giant, bringing its total stake from 9.9% to 38%. Finally, our dog of the week is AutoCanada Inc., symbol is ACQ on the TSX. It is engaged in the operation of franchised automobile dealerships. The stock dropped 20% late last week after announcing weaker than expected Q2 results. Year to date, the stock has been cut in half. Is it a dog or opportunity? Now let's dig into the show. We're going to start with our Your Stock Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock Our Take. Buy, sell, or hold. We got a question sent in from Jonesy via Twitter. Jonesy asks, Mogo has made what appears to be a share price turnaround. Last quarter looked good. What do you think? Well, Jonesy, what we can tell you is that the current price of Mogo is $4.96 in the $5 range. Market cap is around $114 million. What does the company do? Well, Mogo Finance is in the business, it's a mobile first built business. They have an app that users can get access to 6 products through, including free credit score monitoring, identity fraud monitoring or protection, digital spending account with platinum prepaid Visa card, a digital mortgage experience, the Mogo crypto account, and access to smart consumer credit products through Mogo Money. The company lists more than 650,000 members and growing, although fewer than that are paid users. Let's look at the financials behind the business. Revenue in the last quarter was up 34% to $15.4 million. Adjusted EBITDA came at $734,000. That was up 255% from $207,000 in the same period last year. That was Q2 of last year. That is the 8th consecutive quarter of EBITDA or positive EBITDA. Most importantly for Mogo, it's to look at the core revenue growth, which was up 64%. Now, core revenue excludes the company's loan fees related to its legacy short-term loan product. Subscription and service revenues grew 105% year over year, and that represents 50% of the core revenue. That is a great sign. Now, metrics to look at, one to look at would be the member growth rate. For the first 6 months or year to date this year, the company added approximately 110,000 net members compared to around 91,000 net members in the same period of 2018. That's a 21% increase. The total member base has grown 49% to 439,000 members since June 30th of 2017, roughly over a year. It's grown to the level of 654,000 members. This growth rate in its membership reflects management believes its increased brand awareness through its post-media marketing collaboration agreement. It is a solid agreement right now for Mogo, and continued adoption of the company's new and existing products. Now, our take. Fundamentally, it's very difficult to value it. With negative earnings, we can look at an EBITDA multiple, trades at about price to EBITDA on a trailing basis, about 33.4, which is a high multiple. Now, if we look at some other methods to value it, fundamentally, Mogo trades at 2 times analyst estimate of core 2017 net earnings versus the fintech segment or its peer group, on average trading at 5.4 times. Okay, as a fundamental analyst, we are often loath to use sales multiples such as this, as it doesn't factor in cash flow, and cash flows are the ultimate weighing mechanism for equities. I guess in this case, when in Rome, however, this does paint Mogo in a good light, and it may look undervalued on this basis. It was announced today that Mogo's suite of products is now available in Nova Scotia, and the company's Mogo Mortgage solution is now available for consumers in Manitoba, New Brunswick, PEI, and Newfoundland. Expansion in the market-based, larger market opportunity is a long-term positive for Mogo. So if you want fintech exposure in Canada, pure play, it is difficult to get, and you can stomach the volatility, and you want risk capital to go into Mogo. It is a viable long-term option as it grows and monetizes its user base over time. We believe it is potentially a takeover target long-term. It is definitely for risk capital only, given the fact that it is hard to value on current cash flow.
From our Stars and Dogs segment, it's time for this week's Star.
Now let's look at our star of the week. Canopy Growth Corporation, symbol is WEED or WEED on the TSX. Current price is around the $40 range, $9 billion market cap. The stock jumped 30% Wednesday morning alone to its current range, closing close to a closing high, all-time high. Now, what does the company do? Canopy is a growth company, is a leading diversified cannabis and hemp business, offering distinct brands and curated cannabis varieties in dried, oil, and softgel capsule forms. Canopy operates 10 cannabis production sites and over 2.4 million square feet of production capacity. The company has operations in 9 countries across 5 continents. Now, what is driving the stock? This week, the biggest driver was alcohol giant Constellation Brands as it returned to invest another $4 billion in the burgeoning marijuana giant, bringing its total stake to 9.9% from 38%. This overwhelming positive news caused the broader set of pot stocks to surge by double-digit percentage points, with Afria and Aurora Cannabis, 2 other larger players, flying by 20.5% and 19.5% respectively. Alongside this investment from Constellation Brands, Canopy also released its Q1 results. Revenue growth was strong, up 63% to $25.9 million. Adjusted EBITDA, the company still has a loss of $22.5 million, increased from a loss of $3.9 million in the same period last year. From a revenue perspective, the growth was great. The continued losses are expected, not good to see, but having said this, the current financials are not the story. Until we see legalization and the resulting sales this fall, you can't look at this company on a cash flow basis, or it's basically impossible and difficult to do that. Now, the balance sheet looks relatively solid. Canopy's growth in revenues and adjusted growth margins shows very impressive growth. The upcoming legalization of recreational cannabis, these growth numbers can be expected to hit a new gear in the coming quarters. While cannabis growth in production capacity is best in class, it is difficult to predict whether it will be able to keep expenses down enough to have its large revenue growth turn into profitability. We believe in this segment, ultimately the low-cost producers will be the most successful. Canopy is positioned to be a low-cost producer. Whether it delivers on that remains to be seen. Investors, however, liked its growth numbers. its investment partner, and its outlook. And this makes Canopy Growth our star of the week.
From our Stars and Dogs segment, it's time for this week's Dog.
Let's move to our dog. That would be AutoCanada Inc., symbol ACQ on the TSX. Current market price in the $11 range. Now, the stock's market cap is around $320 million. What led to its drop? Well, we'll get to that into a moment. Let's look at what the company does. AutoCanada is engaged in the operation of franchised automobile dealerships. The company offers automotive products and services, including new vehicles, used vehicles, and vehicle parts. It currently operates 68 franchise dealerships comprised of 27 brands in 8 Canadian provinces, as well as in Illinois in the U.S. Now, there was a large drop late last week, August 10th, which was prompted by the release of very weak Q1 financial results. Revenues were down 2% to $880 million. The net loss came in at $41.3 million compared to a gain or profit last year in the same quarter of $25 million. AutoCanada talked in its MD&A, management talked about the U.S. operations have clearly entered into a correction period. Most analysts believe it will last about 2 years. The extent of the correction is uncertain, but during previous cycles, the market declined at least 3% per year, and 5% per year was not uncommon. The Canadian market, management believes, is holding at slightly under the record sales seen last year, but is poised for a slight correction. Both of those are not near-term positives. Now, the most recent quarterly financial results showed decreases across the board in every profitability measure from last year. It also had the first quarter with net loss since Q3 2016. Now, same-store revenue also dropped 5%. Overall, there were many concerning signals in the report, causing investors to significantly lower valuations of the company, resulting in a 20% drop in the stock and making the company, AutoCanada, our dog of the week. That's going to put a wrap on the show for this week. I'm going to thank our listeners and our clients for listening in. Again, keep sending your questions into our Your Stock, Our Take segment. Keep sending us a tweet on Twitter. Keep sending in via the regular social media channels. You can send in by email as well. We'll even take a call if you really want to on a question. Again, thank you this week. Aaron returns to me from his European vacation. We'll get a story on that as well. And profitable investing.